On the last trading day of 2025, the spot gold market was extremely volatile. It traded higher first and then declined, surging to $4,365 at one point. -1 by a sudden sharp drop in the afternoon with a maximum decline of 1.5%, briefly breaking below the key $4,300 integer level. Finally, it barely stabilized and oscillated, closing at $4,309.88, ending the year with a cumulative gain of over 70% and setting more than 50 new intra-year highs. This year-end closing battle not only confirmed gold's strong performance throughout the year, but also exposed short-term market divergences and volatility risks. Everyone must keep this trend signal in mind. In early Asian trading today, spot gold continued the momentum from the previous day, oscillating slightly higher and touching a high of $4,365 at that time. The market was permeated with optimistic sentiment, and many investors thought it would close at a high. However, the good times didn't last long. The market sentiment suddenly reversed in the afternoon, with spot gold plummeting straight down to below $4,300 at the lowest point, a difference of more than $60 from the intraday high, really startling a group of investment friends. In fact, this afternoon's sharp drop was caused by the superposition of multiple factors. On the one hand, the Chicago Mercantile Exchange and the Shanghai Futures Exchange successively raised margin, standards, and price limit ranges, directly triggering automatic profit-taking in program trading. In addition, institutions took profits one after another during year-end settlement, leading to a sudden surge in selling pressure. On the other hand, many traders were on holiday during the festival period, resulting in extremely tight market liquidity and a serious shortage of buyer power. Bears could easily push down prices, and a small influx of selling orders triggered a sharp drop. Insufficient liquidity simply became a volatility amplifier. But talking about the full-year performance, gold was truly the annual star asset, with a cumulative gain of over 70% for the year. It significantly outperformed most marketing assets. Behind this strong trend, there are actually four core logics supporting the market. First, the Federal Reserve's interest rate cutting cycle has officially started. The interest rate cuts throughout the year, coupled with expectations of further cuts in 2026, have directly reduced the opportunity cost of holding gold, becoming the core driving force for gold prices to rise. This factor has really contributed significantly. Second, the global de-dollarization trend continues to heat up. The continuous expansion of the U.S. fiscal deficit has shaken market confidence in the U.S. dollar. The value of gold as a hard currency has been redefined, and investors have begun to view it separately from the U.S. dollar. Its safe haven attribute has been further strengthened, naturally attracting more capital into the market. Third, central banks around the world continue to net buy gold. Countries such as Poland, Kazakhstan, and Turkey have successively increased their gold holdings. Data also shows that 43% of central banks plan to further increase their gold reserves in 2026. These big player purchases have provided an extremely solid bottom for gold prices. Fourth, geopolitical and economic uncertainties have always existed. Coupled with the promotion of market sentiment, capital has continued to flow into the gold market. Gold ETFs alone have accumulated about 800 tons of gold throughout the year, further boosting price gains. This momentum is really strong. After talking about 2025, everyone is definitely most concerned about 2026. The market generally believes that gold will remain at a high level next year, but volatility will further increase. There are actually many favorable factors. The Federal Reserve's interest rate cutting cycle is not over. The global central bank gold buying spree continues, and the de-dollarization trend remains unchanged. These will all provide implicit support for gold prices and limit the space for deep corrections. Everyone doesn't need to worry too much about a sharp drop, But there are two major risks that everyone must be vigilant about. First, the pressure of institutional profit-taking will persist. If the previous gains are too large, triggering more profit-taking selling, it may lead to a phased correction at any time. Second, liquidity volatility and changes in policy expectations. If the Federal Reserve's interest rate cutting pace is lower than expected, or geopolitical risks eased, gold prices may have a correction space of 5% minus 20%. This range is quite alarming, so we must be highly vigilant. Important disclaimer: all content above is for reference only and does not constitute any investment advice. Any trading operations conducted based on this information are at your own risk of profit or loss. Want to receive real-time interpretations of gold price trends and major market news as soon as possible? Subscribe, like, and share with your investment friends around you now. Thanks for watching. Wish everyone a smooth investment in 2026 and make big money.